as you feel my mind, or you feel my mind. We could build a dream, start up something new, and the world is on your shoulders, and you feel like falling over. Just let me in your head, so I can be there for you, there for you. The night is young, won't you sing for me? Won't you sing for me? You will fall asleep.
Hello, everybody. Welcome to VC Masters. My name is Nick Pallavito. I will not be your host today, but I will be joining in on the discussion, which we're going to take a look at ninja entrepreneurship and entrepreneurship in general. Now, with that, we do have a person who is going to be hosting the show, who's actually a professor in the business college at Duke University in Durham, North Carolina, and also has a PhD in computer science and has been involved in more than 125 startups. And it also will bring in Dr. Salman Azhar to the show. Dr. Azhar,
good afternoon.
How are you doing?
I'm doing wonderful. Good afternoon, good morning, or good day, wherever you are. I will be hosting you today. Lots of interesting things to go. We are still waiting for our guest, Dennis, to join us. But meanwhile, I wanted to share with you what's going on in the world of innovation, entrepreneurship, and investment. So you may have heard of DeepSeek that has challenged some of the AI models that traditionally have cost a lot by providing a low-cost, low-memory-intensive solution. And I wanted to share a little bit about that while we are waiting for our guest. So DeepSeek, basically, what they did is that they said, DeepSeek actually, what they actually did was said that instead of aiming for precision, we are going to aim for efficiency. So things that were for example, dollar numbers. They said instead of doing dollars and cents, we'll just do dollars, or even instead of doing dollars and cents, we'll do thousands of dollars. So you may have seen these in financial reports of big companies that they report sometimes in thousands or sometimes even millions of dollars. So what DeepSeek is doing is that when we are talking about millions of dollars or thousands of dollars, it's no point talking about cents, and it may not be a point on talking about individual dollars as well. So as a result, they can operate much more efficiently using much less memory, which in turn costs less. So that has challenged the traditional AI approach that has aimed at precision. The flaw in DeepSeek's approach is that already AI is hallucinating. Hallucinating is actually a technical word, even though it doesn't sound like a technical word. It sounds like something that my teenagers would talk about with each other. So hallucinating means when AI gives you incorrect answers. So as long as you are tolerant of AI answers being inaccurate, you're actually okay with DeepSeek. So, for example, if you are looking at just routing from one point to another and using AI for that, or using AI to, let's say, answer a quiz, and you're going to check the answers, then you are going to use you're able to use DeepSeek. But when you are talking about something like healthcare or sometimes finance, then DeepSeek is going to be a little bit harder for you to use. And with that, let's transition to our host, our panelist today, Dennis. Dennis, welcome to the show.
Thank you.
It's great to have you. I've heard lots of great things about you from Nick and the world in general. And I want to just start by asking you about your story. How did you get started, and what made you successful? What are the learnings other people can do from your experience?
Sure. Well, great to be here. And I love entrepreneurs, have since I was little. And when I was young, my dad wanted me to study entrepreneurs. He was an entrepreneur, medium successful, but he was a striving entrepreneur. And he wanted me to think about all things entrepreneurial, and particularly the stories of those people who got knocked on the rear end and picked themselves up and were able to carry on. And so started my own wealth management firm, also started several other companies, have sold several companies, have done a variety of investing in young startups or medium-sized startups through various university funds and various other angel organizations. So I love all things entrepreneurial.
Lovely. So I want to talk about a little bit about your investment experience. So tell me a little bit about how did you get into investments and what kind of things attract you about investments?
One of my early mentors was a guy named Jean-Marie Eviard. He was on the cover of Money Magazine in 1999, and he was a pretty famous value investor. But the reason he was on the cover was not because of that per se. It was because he had decided to exit the market when everybody else was saying, oh, hey, it's a party, we need to pile in. And so Japan, which was one of his big investments, he exited that. It was on fire at the time. And so one of the things he taught me is that, hey, you can't call the top of the market. And he was somewhat ridiculed for getting out a year and a half before the top of the market. But ultimately, he was proved correct that valuation matters. And so all the individual stock company valuation that I learned early on has helped me in all the other areas that we invest in real estate, in private equity, venture capital. And we do believe that valuation matters, even though today I think a lot of people just sort of ignore what the valuation is. And
yeah, or even think about valuation. So I see all these stocks in, AI or like OpenAI, and then, companies like SpaceX, and they are selling at extremely high valuation. And not only that, people are buying them blindly. They don't even understand the problem they're solving. They do not understand revenue potential and how we are going to recover some of the investments. And I just don't understand that kind of investment. And, my experience has been is that when my Uber driver or taxi driver starts investing in OpenAI or SpaceX, that's the time for me to really be cautious. What do you think?
Yeah, no, I agree with that. Back in the early and late 1920s, one of the greatest value guys in history got off an elevator, and the elevator operator was talking about stock tips, and the guy shining his shoes was talking about stock tips. So when everybody is jumping in is the time to be cautious. And now we are in the techno-industrial revolution, and that changes a lot about the way you think about valuations and metrics. But still, there's a point at which you're priced too much for perfection, and potentially you're going to get hurt if there's any kind of little hiccup. And we just saw that happen with the Chinese AI announcement, and all of a sudden NVIDIA took an elevator ride down. And there's just a lot of things going on in the world that can upset the apple cart.
Definitely. So, you probably are about the same age as I am. And having lived through the dot-com bubble bursting and the financial crisis, it changes you in a lot of ways. And some of the AI stocks, I kind of see the same thing replaying, but more in private markets. Well, actually, both public markets, as you said, mentioned NVIDIA, but even more so in private markets, because they are smaller companies that don't have alternative sources of revenue and growth. So when I look at, for example, Google or Amazon or Facebook, AI is something that is part of their planning, but it is not the only thing, and it's not even something that they are relying on for revenue generation. But a startup that is relying completely on AI for revenue generations were really hit hard a couple of weeks ago. In fact, I'm in the secondary markets, and whenever I'm talking to people that try to sell me these companies like SpaceX and OpenAI, and about 2 weeks ago when DeepSeek news hit, I said, hey, I have some companies that are not AI if you want to look at it. And everybody was like jumping on all of a sudden on it because, those valuations are reasonable. They are like, 4 times the annual revenue rate, annualized revenue rate, unlike, 1,000 times and 100x. And when they saw, it's just 4x revenue rate, and they said, wow, that is really cheap. And I said, that's what I was talking about. And you didn't want to listen. Now you can listen. And so it was really great. That news was great. Personally, I mean, I'm sad for all the people who lost money, but personally, it was a great news for me. Seems like you have managed other people's money as well. How is it different investing your money compared to investing other people's money?
Well, the biggest thing is to understand what they're trying to do with the money, what they're trying to accomplish. And one of our primary constructs is the idea of core and explore. So it really helps when you think about when am I going to trim a particular sector or a particular stock or a particular ETF? And if it's in core money and you're approaching retirement, that may be a very different situation in terms of rebalancing. We rebalanced multiple times last year, and we did it aggressively in core. But explore, meaning the dollars that you don't necessarily need for your financial independence, there the idea is let your profits run and cut your losses short, which is an old, again, value adage. And the ability to let your profits run, if a particular stock or a particular sector gets up to 10% or 15% of that explore side money, well, maybe that's not a big deal because you have a different mindset with that money.
Yeah, so that reminds me of 2 pieces of advice that I heard during my career that's really stick with me. One is that sometimes not taking risk is the biggest risk itself. So the explore money, if you're not taking risk with it, if you put it in like a checking account, that's really a bad idea. And the second one is the opposite, that the money that you are relying on for income, you can't really risk it. And you have to basically minimize your losses as opposed to maximize your income or profits. And that reminds me of a great innovation that I saw recently. There is a blockchain company called Chia. And so set aside the blockchain word for a side, because that invites a whole bunch of interesting conversations. But what they are using the blockchain for is for validation of separating the dividend from the stock appreciation. And they are going with Microsoft as their first beta test, where you can buy an appreciation certificate for Microsoft, which gives you the upside of the stock appreciation. And you can buy the dividend certificate, which just gives you the dividend. So if you are buying, if you're near your retirement age, as you were mentioning, then the dividend stock would be better for you. And that's like backed by Microsoft or big companies like that, which are fairly stable. And dividend is basically a profit sharing way for you to increase, get sometimes a little bit more than what you would get in a CD or even a T-bill. What do you think about that?
Oh, I think it's a great idea. We are living in a world where we can get things sliced and diced any way we want it. So that actually was one of the themes that came out of the Ninja Entrepreneur book is the rise of the customer. In this case, you and I being the customer and consumer of investment products, if we can get just the component we want, sometimes that's better than having both of them mushed together.
Yeah. And, like my brother and I are the opposite ends of spectrum. So he is very risk averse, wants to just get the dividend of a stock. I am the opposite. I seek risk. I get excited by it. I want to kind of make it's just a number. It's not like I'm going to need this money, as to your point. This is like exploration. So I would rather get the appreciation certificate from Microsoft or any company that is backed like Microsoft. And same thing with some of these tech companies that have very low dividend. my brother would be happy to have the dividend. He just doesn't want to take the risk of the stock. And rather than get like a 0.7% dividend from Microsoft, he can get something like 6-7%. And by the way, I'm just making up numbers. I'm not sure exactly what it translates to. So he can get about 10 times the income that he would get from just buying the stock. And I can get much more appreciation, maybe double appreciation, or on the other side, double depreciation as well by buying that stock.
Yeah, yeah. And, back in the days when, for example, in my master's degree, I did my thesis on covered call writing and options used for creating what are called collars, where you're kind of creating a defined range for a particular stock. You fast forward to today, and you can get 100 different varieties of that same thing already prepackaged. So you don't have to do what we did back in the old days, which is buy a portfolio of stocks, sell the call options, take that money, buy put options. You can get it all put together if you want.
Yeah, so that collar is an interesting concept, and some of our guests may not know about this. But what happens in a collar is that, let's say you have a stock, you say that I am going to write a contract to sell this stock if it, let's say, goes up 10%. And I'm going to also buy a contract to sell this stock if it falls below a certain level. So what that does is it creates a range. And in fact, if you are just interested in using the stock market to generate, let's say, a 5% return, you can define your risk and say, okay, anything over 5%, I'm happy to sell the stock. And if the stock falls, then I want to be able to assign it to somebody else so that I can cut my losses. Interestingly, go ahead, sorry, Dennis. Yeah.
Well, no, I was going to say that, and today when we're priced for perfection in a lot of different stocks, particularly the Magnificent Seven, we have clients who have held the stocks for a long time. They have massive gains that would be taxed if they sold. And so creating that collar that you just described, maybe we can protect down to more than 10% on the downside. We don't take that risk. And on the upside, in many cases, we can get 12, 14% on the upside in any given calendar year. And sure, stock returns are clumpy. Everybody talks about the long-term returns in stocks, 9, 10, 11%. They never do 9, 10, or 11% in any given year. They're always way up or, 2% or down. 75% of the time they're up. And so, you might leave some chips on the table, but if it's part of a risk mitigation strategy, again, depending on age and stage of life, a lot of good tools out there today to take advantage of.
Definitely. I was talking to somebody who is doing something similar in private markets for VCs and stuff, where the VCs can basically sell a covered call, which basically says, I'm not going to go out over a certain appreciation, get some income from that call as well. The put spot or the downside protection hasn't come in that way. The downside protection has come in, is actually part of the venture capital that very few people understand. And that simply is that the investors, when they invest, let's say, to buy 20% of your company, their 20% gets paid off first before you get paid off as an entrepreneur. And I just feel sometimes if people can understand downside protection concept in the VC market is not as risky as people think it is. What do you think?
Yeah, we participate, as I mentioned earlier, at lots of different levels in the VC market and even pre-VC and angel markets. And one of the things that I was asked to do around the Ninja Entrepreneur research last year was to go to a company, a venture capitalist in offices in LA and Singapore. And they wanted to do a couple of days of very intense discussion with all of their analysts and partners on two things. One is what you just described. how can we think about risk in a better way in an environment, the techno-industrial revolution, where things are moving and accelerating at a faster rate than any time in history, and it's getting faster on us. And so that environment, they tech enable a lot of things with artificial intelligence or augmented intelligence, and some of them are real features of the products or services of the companies they invest in. Some of them I think are just kind of, well, we're going to dabble in it and see if this works, but we have a great business plan anyway. So, we put a little veneer, a little AI washing on the thing, and maybe it looks a little more attractive when we go to our next round of financing, or what's more frequent is we'll figure it out as we go along, which, by the way, is a mantra of entrepreneurs. We'll figure it out as we go along. Some do that extremely well, and others, maybe take a wrong turn at some point.
The worst investment decision I ever made was Google. And the reason that it was the worst was that I had an opportunity to invest in them when they were very early on. And I decided to pass because they said, we'll figure it out figure it on the way. And the question that I had for them was, how are you going to make money in search? There's no money in search. And that kind of was a very humbling experience for me overall. And not only did they survive the .com bubble bursting, but they are thriving, and search is still making more money for them than anything else that I know.
Yeah.
Any single, maybe iPhone is making more money when you include all the peripherals and all the ecosystem for Apple.
Yep. And there are massive threats out there as we speak from both the public and private market against Google's business model. And, this recent report they had, a few points were a little squishy, but generally speaking, ad revenue has held up. And so, will there be a disruptor out there that upsets its apple cart? Well, it can happen. And, we do a lot of work, for example, in the Ninja thing, we talk a lot about the moat around the castle and how strong a moat does a company have, barriers to entry, barriers to barbarians, coming over the castle walls. Well, public companies, same thing. And there's some amazing companies. I was in Silicon Valley not too long ago, some amazing private companies that are taking aim at specific niches of Google and NVIDIA and others. Now, they're like a mosquito on an elephant's rear end right now. For most of these companies, they're like, they swat them to get them away, or they buy them. I mean, this is the becoming now the golden age. Is one of the reasons I'm so bullish on private equity again, after having a little bit of a frozen age for about a year and a half, and golden age of many of these companies scooping up companies that they think will be additive to their future growth in revenues and earnings and knowledge about AI and so forth.
Yeah, lovely. So, as far as the moating moat is concerned, it comes from like preparing your city or your castle against invaders. So it's exactly the invasion analogy that you used.
And what do you do when the barbarians have helicopters?
Yeah, so then you need some kind of a land-to-air missiles and stuff like that. It's a different kind of moat, and your traditional moat is not going to protect you. But that's actually an interesting thing, that innovative competitors actually invite innovation for you to protect yourself. So one of my favorite companies these days is Chorus, and Chorus basically has about 600 patents that protect us against anybody generating the kind of light spectral recipe that they are generating. And their patents are really their protection, because if anybody invades their patent, basically they can get a royalty, and they usually settle with them and so on. And they have a whole kind of like a path to IPO just based on licensing their patents. But there are other ways to do that as well. And in a lot of software companies, the moat or the protection is more about trade secrets, which means that Facebook can show you the messenger, you can reverse engineer the messenger, but you cannot get the code from Facebook to do that. And you do not have all the backend intelligence information that Facebook is generating on that. So that's kind of reminds me of the barbarians having helicopters. What do you do now? Well, you have to have a different kind of thing. So the traditional IP where you would patent and stuff is still like whenever you can, that's the most defensible moat that you can have. But then you have helicopters, and for helicopters you need different kinds of things, maybe camouflage and stuff. What do you think?
Yeah. Well, and so a company in our backyard, your backyard also, that is written about extensively in the Ninja Entrepreneur book is called Voxel, and they're an advanced manufacturing company. And what is amazing about what they've done, they have some of the things you just talked about as far as protections against barbarians, but they've also just done what they do so well that they had a major national entity who really wanted to increase its manufacturing of a particular item for law enforcement, and that entity paid for the entire manufacturing line. Wow. So yeah, I mean, and there's several stories. Ninja Entrepreneurs originally was over 600 pages long, and we said, okay, nobody's going to read this, so we skinnied it down to about 230. But Voxel stayed in there because of a whole bunch of different chapters, just because of some of the really intense and unique things that they're doing. And Daniel Harrington, the CEO and founder of Voxel, is a former race car driver. So there you go. Entrepreneurs can come from almost any stripe.
Now, can you talk a little bit more about the book? Because I always believe if you read a lot of these books, Dennis, you can actually get better at being an entrepreneur. But tell us a little bit more about the Ninja Entrepreneur book and how you went about writing it.
Yeah, so because we have worked with so many private companies for decades, we were fascinated by all the problems that the pandemic brought to so many private companies, some public companies too, but private companies in particular. And so it was really just 3 months into the pandemic that we started sitting down with private companies and saying, hey, what are you doing differently now that you're in this environment? And of course, depending on their product or service that they sold, some of them were in a OMG, I have to pivot 180 degrees to figure out how to, keep the lights on. And others, just had to make tweaks along the way. But it was pretty disruptive for most companies. And after about 6 months of interviewing a bunch of companies, we realized that, okay, there are some patterns here. There's patterns in leadership. Some of the old school leadership things are still absolutely true, but there's new style leadership, particularly with the new demographics, some of the younger folks coming into companies and how you manage them and how you give them enough rope, but don't give them too much rope, and all those things that have been written about in 100 leadership books, right? But the fact is that we noticed there were some changes, and particularly among our top ninjas, the top 10% of the 120 companies, there seemed to be a more flexible leadership style and driving leadership, not just to the leadership team, as opposed to the authoritarian dictator at the top, but the leadership team, but then even below the leadership team. And some fascinating stuff came out of that. One thing that came out of it, we were working with a Navy SEAL and looking at some of the things in his company that he had started. And he talked about the Navy SEAL credo of being able to slow yourself down sometimes in order to speed up or make sure you're going in the right direction.
Mhm.
Well, we've seen entrepreneurs generally be in a ready, fire, aim mode, where they're just going to go out and do it, and they're going to, again, some conversation we were having a little bit ago, they're going to figure it out as they go along. And this was a little different. This was, things are moving so rapidly that if you're just in that fire drill mode all the time, you may miss the pivot that you need to make. So the number one chapter that we get feedback on out of Ninja Entrepreneurs is the chapter on pivoting and adapting. And the paranoia, and I get it, because I've seen a lot of examples of this. The paranoia is that you're not going to figure out, first of all, how to adapt to this new world we're in. It'll be, this world 5 years from now, 10 years from now, you may not even recognize it at a lot of different levels. And so, how do you adapt? But then how do you pivot when you're not in a crisis? And that's the issue, is that so many business owners, even some very successful ones, even Warren Buffett, pivoted during a crisis.
Mhm.
But what if you actually pivoted before the crisis? Would you somehow get the answer better? Yeah. So
It's definitely very difficult. The hard thing, there aren't too many books on entrepreneurship, Dennis. So I saw that, I was thinking, what a great idea, because it is a way that people can do very well financially, but there's no roadmaps and very few courses. I don't know if they have courses at Duke, Dr. Azar, but very few courses when I was in school, if any, on entrepreneurship. But with that, we're going to have to leave VC Masters and our viewership in the United States and around the world. And we will see you next week on VC Masters. And thanks, Dennis Stearns, the CEO of Stearns Financial Group, and he founded it from the bottom up bootstrap. That you have to give him a lot of credit for. Okay, and we'll see you next week. Bye-bye.
I go anywhere with you, 'cause you fill my mind, or you fill my mind. We could build a dream, start up something new, and the world is on your shoulders, and you feel like starting over. Just let me in your head so I can be there for you.